How can you turn inflation into an opportunity to make money? It sounds too good to be true, right? But what if I told you that there are 3 simple ways to profit from inflation, methods that most people are not even aware of? In this video, brought to you by No Money, we're going to uncover these strategies that can help you make substantial returns year after year. Stay tuned until the end because we'll also reveal where to use these strategies and where not to, which is crucial for maximizing your gains. Method 1. Buy property with 30-year fixed-rate debt.
Hey guys, what's going on? So I just wanted to hop on here and talk about why a 30-year mortgage might be the best mortgage option for you. So here it is. So when you get a 30-year mortgage, that means that you have twice the amount of time as a 15-year mortgage to pay off that mortgage. Now, when you have more payments, that means that your monthly payments are less. When you have less amount of monthly payments, you have more positive cash flow. When you have more positive cash flow, that means that you're going to be able to expand at a faster rate. So if you're looking to use leverage and a lot of leverage to grow your real estate business, I would recommend and use this tactic because with positive cash flow, you're going to be generating good.
One of the most effective ways to profit from inflation is by buying property with a 30-year fixed-rate mortgage. Let's break it down. Imagine you purchase a house worth $100,000 with a $20,000 down payment. In the first year, if inflation rises by 10%, the house's price also goes up by 10%, reaching $110,000. The actual value of the house hasn't increased. It's just the price that has risen with inflation. Here's where the magic happens. You initially invested $20,000, and now the house's price has increased by $10,000 due to inflation. This means your investment has effectively grown by 50% in 1 year, even though the house's purchasing power remains the same. The price hike resulted in a significant return on your initial investment. This happens because the value of the debt decreases over time as inflation rises. Your mortgage payment remains fixed, but the dollars you use to repay the loan are worth less, reducing the real cost of the debt. Furthermore, the gains from inflation are amplified because of leverage. You only put down $20,000, but you benefit from the price increase on the entire $100,000 property. This leverage effect means your returns are much higher than the rate of inflation. However, this strategy works best when interest rates are lower than the rate of inflation. If you lock in a low interest rate, your debt payments stay the same while the property's value and your income rise with inflation. This creates a gap that represents increased purchasing power. Method 2. Leverage long-term gains with inflation. The second method involves leveraging long-term gains through inflation. To understand this, let's take a closer look at how inflation works. Consider a scenario where the total money supply is $60. Your home costs $20, your income is $20, and all your other expenses also amount to $20. If the Federal Reserve doubles the money supply to $120, prices of everything, including your home and income, will double as well. Now, while your home price and income increase, your loan remains fixed. This creates a gap between your rising income and steady debt payments, which translates into increased purchasing power. Over time, as inflation continues to rise, this gap widens, providing you with more disposable income. However, the key factor here is the interest rate on your loan. If your loan's interest rate is lower than the inflation rate, you benefit significantly. For example, if your interest rate is 3% and inflation is 6%, the 3% spread represents your increased purchasing power. Conversely, if inflation is lower than your interest rate, the benefit diminishes. Method 3. Renting out properties.
Renting out your properties as an investor. That's right. I keep telling you to buy and hold these things, which means you're going to have to put somebody in there, right? How do you do that? Well, number one thing I tell you is to put it in your budget when you're budgeting the whole project, when you're considering buying it, is to work in that 5 to 6% to have a property manager do this for you. That is my absolute number one advice. Don't try to do this yourself unless you really want to. And even if you really want to, I'm still going to tell you don't do it. So if you are going to do it yourself, you want to be putting people in on a lease option basis. In other words, have them come in, pay a little bit extra for that option price to buy the property at some date in the future. 80% of them will never perform. However, they take care of the properties. They take care of the properties like they are their own. It's the way to go. If you're going to absolutely do it yourself, get a lease option tenant. Do not put a month-to-month tenant in the properties, but please use a property manager.
Another effective way to profit from inflation is by owning cash flow positive rental properties with a 30-year fixed rate mortgage. This method not only leverages the benefits of a fixed rate mortgage, but also adds the advantage of rental income increasing with inflation. Imagine you own a rental property with a fixed rate mortgage. As inflation rises, so does the rent you can charge your tenants. While your mortgage payments remain constant, your rental income increases, creating a growing gap between your income and your expenses. This gap represents additional cash flow, which is essentially profit in your pocket. One of the key benefits of this method is that your tenants are effectively paying the interest on your loan. Even if interest rates were to cut into your cash flow, the burden of these payments falls on your tenants, not you. This means that the entire increase in rent due to inflation becomes your profit, enhancing your purchasing power over time. Even in a deflation scenario where rental income might decrease, there's a chance that interest rates could drop as well. If this happens, you could refinance your original loan at a lower interest rate, maintaining or even increasing the gap between your rental income and debt payments. This scenario, while not as straightforward as profiting from inflation, still offers a potential hedge against economic downturns. The key to maximizing this strategy is to invest in areas with strong rental demand and favorable economic conditions. Cities with growing populations, low property prices relative to inflation, and supportive government policies are ideal. These factors ensure that your rental income will continue to rise, even as the economy changes. In summary, owning cash flow positive rental properties with a 30-year fixed rate mortgage allows you to harness the power of inflation to generate consistent and increasing profits. This method turns inflation into a reliable source of income, safeguarding your financial future against economic fluctuations. Areas to avoid. While using 30-year fixed-rate debt to invest in property can be highly profitable, there are certain areas you should avoid. Cities like San Francisco, Los Angeles, Portland, and Seattle are prime examples. These cities have extremely high property prices, which historically exceed inflation rates. Moreover, they suffer from unfavorable government policies, such as high taxes and rent control, which can severely impact your investment returns. Real estate markets in these cities are also heavily influenced by asset prices. If the stock market crashes, property values in these areas tend to plummet as well. Additionally, rising interest rates could further depress property prices due to the significant debt in these markets. Another factor to consider is the population trends. Cities like Los Angeles are experiencing a slowdown in population growth, with potential decreases in the near future. This can lead to higher vacancy rates and lower rental incomes. Lastly, these cities often face significant social issues, such as homelessness, which can further negatively impact property values. Therefore, avoiding these high-risk areas can help you safeguard your investments. Where to buy? For a better chance of profiting from inflation, focus on cities with strong economic fundamentals and lower property prices. Consider investing in areas like Kansas City, Nashville, and Little Rock. These cities offer much more affordable real estate compared to inflated markets like San Francisco. These locations benefit from better government policies, lower taxes, and less exposure to volatile asset prices. Additionally, these cities have a growing population, which supports rental demand and potential property value appreciation. Investing in such areas can provide a stable and profitable environment for leveraging inflation with 30-year fixed-rate mortgages. In summary, by strategically buying property with 30-year fixed-rate debt, leveraging long-term gains through inflation, and investing in cash flow positive rental properties, you can effectively turn inflation into a powerful tool for wealth creation. Remember to choose your investment locations wisely to maximize your returns. If you found this video informative, then don't forget to like and subscribe to our channel No Money for more insightful strategies. Thanks for watching, and we will see you in our next video.